So for some of us, the next stock market crash will just be a news headline that will hardly register with us. But for others, it'll be an end of days event that will change everything, change the rest of our lives. But for most of us, we'll sit somewhere in between. An important thing for you and me is that we understand where we are on that spectrum. Okay, so to bring this to life, I wanted to chat about 4 different people. The first one is Fiona. Let me introduce you to her. So Fiona is 40 years old. She has a company pension, and she also pays into a self-invested personal pension, a SIPP. She expects to retire at around 60. So the stock market crash that's about to happen tomorrow in our imaginary scenario will knock down the stock market by 20%. She knows she's got 20 years for the stock market to come back up again. And if she looks at the stats of big falls in the past, then there's very few instances where 20 years won't give the opportunity for stocks to rise again. So she's feeling fairly confident. And although she's sad about the stock market, it's not really worrying her too much. Next, let me introduce you to John. Now, John's approaching 60. He's fairly risk averse. He's got a large SIPP portfolio. And his intention is, in the next couple of weeks, is to start approaching insurance companies. He's going to buy an annuity. If the stock market falls 20% tomorrow, this will be an absolute disaster for John. He'll effectively lose his retirement. 20% are drop in the stock market tomorrow. A couple of weeks before he buys an annuity will mean he probably needs to work an extra 5 years to make up the difference. Having saved for 30 years, then to find it all disappear overnight in the stock market crash tomorrow in our imaginary scenario will be an absolute disaster for John and will impact him really heavily. Next, let me introduce you to Sue. So similar to John, Sue is 59. She's due to retire very soon in the next few months. And she's really diversified her SIPP. So she has a work pension. She has a couple of defined benefits, but her SIPP, a self-invested pension, is split 60% bonds and 40% stocks. It was the other way around. So 5 years ago, she had most of her assets or investments in stock. But as she knows, she's been moving closer to retirement. She's moved more and more into bonds. So although this drop in the stock market will impact her, this will be covered quite a lot by the fact that she's in the bond market, which won't be impacted as much by the crash. Finally, let me introduce you to Tony. Now, Tony's 35. He has got 25 years now before he thinks he's going to be due to retire. His investments are mainly in a self-invested pension pot. Doesn't really have anything in terms of defined benefits. Never really got involved in a work pension, preferred to manage it himself. Very risk averse, John, and he's got 90% of his portfolio split between money markets and some bonds as well, with very little in shares or ETFs at all. Now, John, when he sees the crash happen tomorrow, he thinks, well, I'm safe here. I've made the right decisions. Actually, he hasn't. So he's 25 years away. The opportunity cost of being in low return investments for John is really going to damage his retirement. With a selection of bonds and money markets, he'll have been averaging between 3 and 6% for the whole time he's been investing that money, where if he'd had it in stocks and shares, he'd been looking at more like 9%, 10%. So he's really damaged his portfolio. If he continues with this strategy right up until for 25 years until he retires, then he will have lost hundreds of thousands of pounds, and will probably find when he gets to that point that his retirement is ruined and he does need to go in and work some extra years to make up the difference. All them images are AI generated and none of them people actually exist. However, there are people in similar situations, and I wonder if any of them situations are remotely similar to your own. And do you need to think about whether you're invested in the right mix of bonds and shares, and do you need to worry about a stock market crash? Now, the Shiller PE chart at the moment is running above 35. If we look historically at times when the Shiller's been above 35, then we've never been too many years away from a crash. So we can't discount that it's something of the past. It is likely that there will be a crash at some point. I'm not saying it's tomorrow. I'm not saying it's next year. Nobody knows that. If we did, we could all be millionaires. But the way I'm looking at the stock market at the moment is around opportunity costs. So although I do recognise, only being 55, that at least some of my pension I won't be drawing for 20 years. So the money that's sitting in my SIPP that I'll be using after I'm 75, for example, is 20 years away still. So I don't need to worry about that too much. But what I am worried about is the opportunity cost. If the stock market did drop 20% tomorrow, I would hope I would have enough liquid assets or investments in my SIPP that I could then move into stocks. So, for example, I have quite a lot of my money, far too much actually, in the money markets. Well over 70% of it in the stock market, in the money markets. So if there was a 20% crash tomorrow, I would certainly tomorrow look to be converting that into stocks and shares and buying while the stocks are 20% lower than they are today. Now, it's obviously never that simple, but that is one of when I've been thinking about the risks of stock market crashes and how my portfolio sits in the timeline for when I'll be wanting to withdraw funds, that's my main priority, is to have enough assets that won't be hit immediately by a stop in the drop in the stock market, which I can then convert into stocks at much lower costs. So I hope this has been of interest. I'm not a financial advisor, so what I'm sharing here is some ideas about some different types of people who might be in different circumstances, and sharing something about what my circumstances are. But if you are concerned by anything in this video, or concerned about a potential drop in the stock market, then please do make sure you see someone, a financial advisor, to get some proper information before making any decisions to change or even stay with your current strategy. It's important that you speak to an expert on this.
So if you've heard my outro, then thanks for listening. And if you haven't, then here's probably the most important bit of investing advice you'll hear on YouTube. Don't buy or sell shares in a company based on what someone on YouTube tells you. The big Wall Street analysts have large teams of professionals with access to vast amounts of data on every single listed firm. There are no YouTube gurus who know better than them. Use YouTube to find interesting bits of information on companies that you may otherwise miss. And when you find something interesting, do your own digging and see what the analysts in the big firms are saying. Never invest more than you can afford to lose, and don't expect to get rich quick. If you are interested in my background, I come from 16 years in risk management with PwC and Deloitte. I've never been on a trading floor in my life, but if I had, it wouldn't give me the edge on the big firms because they have big teams and masses of information. So don't look for a guru with an edge. Look for information on companies you're interested in. And if you're looking to invest a large amount of money, don't put it on individual stocks. Choose an index fund. The All World Index is a representation of all the stocks in the world. And if one company goes broke, then the index won't even move. Whereas if you've only invested in that one company, then you may have just lost your pension. Keep it fun, keep it affordable, and subscribe to keep getting my updates. Thanks.